Happy New Year, my fellow friends of Real Estate Investment Trusts. Now, in this week's video, we are going to encapsulate and calculate for you the compounded annual growth rate of investing in REITs. Now, does it make it worthwhile? Does it actually make it a good alternative asset class to be putting your money for this current year, 2023? Now, of course, to actually look into 2023, we have to go back to what 2022 actually tells us in terms of real estate investment trust prospects for this particular year. So tell us, Gabriel, share with us some of the lessons that one actually takes away from 2022 and what it actually portend for 2023 in terms of basically the structure of the REITs, which are the underperformers and which are the likely outperform. Well, just to follow up from my book, ladies and gentlemen, that is actually Making Your Millions in Real Estate Investment Trusts. Now, on page 40, as well as basically page 42, I've listed the winners in terms of real estate investment trusts. So this actually talks about performance in the last decade. So continuing and collating this detailed, meticulous data, you notice that essentially real estate investment trust was a good asset class to invest in, as in basically you have a number of REITs that were able to deliver more than 7% CAGR, in the last decade. Now, this basically means they are able to double your money in a course of 7.5, 8 years. But is this the case now? If you look at 2022 numbers, so now the year that just ended, if you look at this data, now you'll be surprised. You'll be surprised. Yes, ladies and gentlemen. In fact, you'll be shocked, that 14 out of 38 REITs that were listed as at end last year, which is basically just last week, posted negative CAGR. This means, ladies and gentlemen, that if you invested in this 14 REITs, you would have lost money. Unfortunately, some of them, of which if you had unfortunately invested in them, you have lost big money. But first and foremost, let's take a step back and understand what is CAGR. Now, ladies and gentlemen, if you look at the definition of CAGR, it is actually the meaning of a smooth return, where you take its beginning value, in this case, its IPO price of the REIT, versus its ending price. In this case, the ending price is the price as of end of last year. Now, in the intervening period, especially for REITs, you notice that you get regular dividends, be it quarterly or half a year. Now, you actually add them up. So that's why in my column there, that you have cumulative DPU. So I have actually accumulated or calculated the cumulative dividend right up to the end of last year. Yes, it's a very tedious process, meaning that you have to follow this REIT, their dividend since IPO. And we have done that both in my book, ladies and gentlemen, as well as an updated one, which is basically in our latest monthly publication. So Gabriel, what does the numbers showed in 2022? What does it tell us about REIT performance? What does it actually tell us about REIT as an investment asset class? How attractive it is as compared to say bonds or equities going ahead? As I've mentioned, ladies and gentlemen, in our research, you can see clearly some of the REITs that have posted huge losses. In terms of negative CAGR, these are the REITs that have underperformed. Top on the list is actually Digital Core REIT, ARA US Hospitality REIT, where the CAGR is minus 22%. Daiwa Logistics REIT, if you do recall, they were just listed the year before, and the CAGR is a negative 13%. Then you actually have Prime US REIT, which is terrible, terrible. It's actually down with a CAGR of 11.5%, despite being listed, since 20, or rather since 2019. Then you actually have United Hampshire. You also have Cromwell REIT, which is one of the longest listed REIT, but yet the CAGR is negative. It was listed in November 2017, and as you can see from the table, it's still down 9.8%. So much for its aggressive acquisitions. Has it actually come up to anything? Or nothing in this instance. Then you have Elite Commercial. Then you have Livermore's, one of the worst performing REITs, for many, many years already. Then you have Manulife, one of the worst REITs that performed last year, underperformed last year, which we have warned about first 3, 4 years ago in my book, as well as actually in my various YouTube channel, in throughout the course of last year. You notice that they actually posted negative CAGR of minus 3.6% for Manulife REIT. Then you actually have Keppel Oak Pacific REIT. Again, it is down on negative CAGR. And then to round up the list, we have OEE Commercial Trust, Fraser Hospitality Trust, BHG Retail REIT, and Lendlease REIT, which has suffered a very, very negative minor, though it may be, minus 0.1% CAGR. So what it actually portends and teaches us, ladies and gentlemen, is that when you actually pick REITs, unlike what REITs used to be a decade ago, which is almost assured of doubling your money by posting CAGR of 7 to 8% every other year for the last decade, the newer REITs, that is actually those listed in the last 12, 13 years, you will have a hard time actually picking out good REITs that deliver positive returns to you. As a matter of fact, if you actually look at the last 7 REITs that was listed, including United Hampshire Digital Core, as well as actually ARA Life, as well as Daiwa, uh, and a few others, you notice that the last 7 REITs that were listed in the course of the last 3 to 4 years, you would have lost money in all of them, since its IPO, as compared to essentially the price that you saw end of last year. So it actually boils down to what we've been teaching all these years, which in this case, this year is our 34th year of financial education in real estate investment trusts, as well as actually technology stocks and basically all other related investments, is that correct stock picking, correct REIT picking is key in doubling and making your millions in real estate investment trusts. So for more of this, do join us for our class on the 25th of February. You can actually sign up now and enjoy this special early bird price, and for which we devote half a day to discuss with you essentially the key REITs to have in your portfolio, the key REITs, that not to have in your portfolio, practically the potential rotten apples that are likely to appear, and you notice that some of this, rotten apples may actually start to breed its crown years ago. That's why in my book, 4 years ago, I have already highlighted the likes of Cromwell, the likes of Manulife that were underperforming. And true enough, in the last 3 to 4 years, you notice that they have severely underperformed, particularly last year. What other shocking developments, is actually Carl from understanding the CAGR prospects of REITs calculated as of the performance last year, and what does one hope for? As you can see, ladies and gentlemen, from the table again, um, of the 14 REITs that underperformed. So can you imagine you have 38 REITs, so 14 out of the 38, that's 40%, essentially have lost money for investors in the course of its um, uh, listing in Singapore. And of the 14 REITs, you can see 9 out of 14 actually posted huge capital loss, meaning if you just take the price at the end of last year minus its IPO price, 9 out of the 14, that actually posted negative CAGR. So you can see, ladies and gentlemen, that the odds on losing money in REITs have actually changed in the course of me uh, first writing the book. From actually being able doubling your money previously to now currently being able to lose money for you. So REITs as an alternative asset class has been very disappointing, based on the prices that we saw. So of course, many of you will ask, is essentially just a 1 year phenomenon? Is it something that will lead on to the 42023? Let me know your views by commenting below. Send us your comments and we can actually delve into it. You may also wonder, that after this fiasco, does REITs is no longer losing its luster, in terms of its durability, in terms of its ability to deliver the capital gains and dividends for investors. So if you have qualms, you have worries, once again, give us your comments below, yes, and we'll try to address that. So Gabriel, what are the prospects for REITs, in 2023? Is it still as dull? Is it still as basically rather volatile, in this year as compared to last year? Ladies and gentlemen, we try to be as honest and as truthful with you. It's until and unless interest rates peak or the Fed indicates a pivot, the volatility underlying real estate investment trust that you saw since March of last year, when the Federal Reserve first raised interest rates on 17th of March, will continue into the first half of this year. But let me end by telling you that it is not that bad because one, we have already undergone the longest suffering REIT correction, down 24%, down over a course of close to 10 months. This is by far the longest since the Singapore S-REIT history. So is there actually good prospects going in the second half of the year? The answer is yes, because I personally expect the Fed to actually pivot. I don't think that we can avoid a recession. It could be a mild one, but it will then be interesting because as long as the Fed starts to indicate that it will stop increasing interest rates and start to ease, because the earlier indication is that they are likely to hold rates for a longer period of time. Our theory is that essentially, as long as bad news become less bad, it will still be bad, but the incremental badness is not as bad as previously thought. It may be sufficient to breed the ground for a strong REITs rebound. Of course, we will discuss this in detail in our class on 25th February. Hope you can join us, and do smash the subscribe button so that you'll be updated on a weekly REITs update. See you next week.